Hey everyone, and welcome back to the channel. Are you tired of just saving money and want to see it actually grow? Do you dream of building real wealth, but feel overwhelmed by the idea of investing? You're not alone, and you've come to the right place. Many people think investing is only for the rich or for financial wizards. That's simply not true. Today, I'm going to break it down for you with 5 simple, actionable steps that any beginner can follow to start their investing journey. By the end of this video, you'll have a clear roadmap to begin building wealth, no matter how much you're starting with. So grab a notepad and let's dive into how you can make your money work for you. Trust me, your future self will thank you. Our very first step, and arguably the most crucial, is setting clear financial goals. Why? Because without a destination, any road will do, but you might not like where you end up. Goals give your investments purpose and direction. Think about what you're investing for. Is it for a comfortable retirement in 30 years? A down payment on a house in 5 years? Maybe it's for your kids' education or even just to have more financial freedom sooner. Write these down. Make your goals smart, specific, measurable, achievable, relevant, and time-bound. For instance, instead of "I want to retire rich," try "I want to save $500,000 for retirement by age 60 by investing $300 monthly." This clarity is powerful. Knowing your goals helps determine your investment timeline and the level of risk you might be willing to take. A long-term goal like retirement allows for a different strategy than a short-term goal like saving for a car next year. Step number 2 is all about understanding your risk tolerance. This sounds technical, but it just means figuring out how comfortable you are with the possibility of your investments losing value, especially in the short term. Investing always involves some level of risk. Generally, investments with the potential for higher returns also come with higher risk. Lower risk investments, like bonds, typically offer lower potential returns but are more stable. Your risk tolerance depends on several factors. Your age. Younger folks can often take more risk. Your income stability, your financial obligations, and frankly, your personality. Can you sleep at night if your investments drop 10%? Be honest with yourself. There's no right or wrong answer. Understanding this helps you choose investments that won't cause you undue stress and that you can stick with, which is key to long-term success. Alright, moving on to step 3. Choosing the right investment accounts. This is where you'll actually hold your investments. There are a few main types that are great for beginners, each with its own benefits. First, there are standard brokerage accounts. These are flexible accounts offered by many financial institutions where you can buy and sell stocks, bonds, ETFs, and mutual funds. They're a good general-purpose starting point. Then there are retirement accounts, which offer significant tax advantages. In the US, common examples include a 401k, often offered through your employer, or an individual retirement account, IRA, that you can open yourself. A 401k might come with an employer match. That's free money, so definitely take advantage of it if you can. IRAs, like a Roth IRA or traditional IRA, also have tax benefits that can supercharge your savings over time. Opening these accounts is usually straightforward. Most can be done online in a few minutes. The key is to pick one that aligns with your goals, especially considering those tax benefits for long-term goals like retirement. Now for the exciting part, step 4, selecting your actual investments. This is where people often get stuck, but let's simplify it. For beginners, a few core options are usually best. You've probably heard of stocks, which represent ownership in a company. You can buy individual stocks, but for beginners, that can be risky and require a lot of research. It's like picking one horse in a race. A great alternative is exchange-traded funds, ETFs, or mutual funds. These are like baskets holding many different stocks or bonds, offering instant diversification. Diversification just means not putting all your eggs in one basket. Index funds are a popular type of ETF or mutual fund. They aim to mirror a specific market index, like the S&P 500, which tracks 500 of the largest U.S. companies. They are typically low cost and have a good track record over the long term. Bonds are generally considered safer than stocks. They're essentially loans you make to a government or a company, which pays you interest. They can add stability to your portfolio. For most beginners, a mix focusing on diversified stock ETFs is a solid start. Don't feel you need to pick perfectly from day one. Start with a simple, diversified approach, like an S&P 500 index fund. You can learn and adjust as you go. The most important thing is to get started. Our final step, number 5, is to automate your investing and review it regular, but not too regularly. Consistency is your best friend in building wealth over time. Set up automatic transfers from your bank account to your investment account each payday. This is called dollar-cost averaging. By investing a fixed amount regularly, you buy more shares when prices are low and fewer when high. It takes emotion out of it. This set it and forget it approach helps you stay disciplined and build your portfolio steadily without having to think about it constantly. Even small, consistent amounts can grow significantly over decades thanks to compound interest. How often should you review? For long-term investments, checking once or twice a year is usually plenty. Constantly watching the market can lead to emotional decisions. Your review should focus on whether your goals or risk tolerance have changed. You might also need to rebalance your portfolio occasionally if one type of investment has grown much faster than others, to get back to your desired mix. But for the most part, patience and consistency are the names of the game. So, there you have it. 5 simple steps to start investing. Set clear goals. Understand your risk tolerance. Choose the right accounts. Select your investments. Think diversification. And automate and review. It's not rocket science. The most important thing is to take that first step. Investing is a marathon, not a sprint. Don't be discouraged by market ups and downs. Focus on your long-term plan. You have the power to build a brighter financial future. What did you think? Are there any steps you're still unsure about? Let me know in the comments below. I read every single one. And if you found this video helpful, please give it a thumbs up and subscribe for more content like this. Thanks for watching, and I'll see you in the next video. Start building that wealth.